The top business stories live from the Sky News City studio. All change. Labour pledges to renationalise Britain's railway network within a first term of government. Shares of the FTSE 100 mining giant Anglo American surge on news of a $39 billion takeover approach. Plus, all the latest from the markets as some of the UK's biggest companies publish their latest financial results. Good afternoon. This is Business Live with me, Ian King. Labour has promised the biggest shake-up of the railways in a generation, fully nationalising the network within 5 years of coming to power. The Shadow Transport Secretary, Louise Haigh, said a Labour government would transfer the 10 remaining privately run rail franchises to state control within its first term by folding existing rail track contracts into a new body called Great British Railways as they expire. The rolling stock operators, which was set up to supply new trains to the railways following privatisation, would remain privately owned and operated. Well, with me now is Matthew Lesh. He's Director of Public Policy and Communications at the Institute of Economic Affairs. Matthew, good afternoon to you. The rail industry has said nationalisation is a political rather than a practical solution that will raise costs over time. What do you think?
Well, I think there is a significant risk that this nationalisation effort turns into a complete disaster. It's worth noting that when railways were previously nationalised, the results weren't particularly good. There was a huge dive in passenger numbers, there was massive cuts in lines, and the system wasn't particularly efficient. We also saw even bigger strikes from the unions at the time. Post-privatisation, post-1995, we saw more than doubling of passenger numbers, we saw huge amounts of investment. Now, no one's saying the current system is perfect, but it can almost only get a lot worse. And what Labour's talking about doing here is creating this big new bureaucracy called Great British Railways, which will then be overseen and watched by another bureaucracy, a passenger advocate bureaucracy. And then it's going to somehow magically make the system work more efficiently, somehow magically going to ensure the unions are satisfied. They're going to somehow, despite all the limits for public funds, ensure that there's proper investment into the system. I think there's a lot of questions here, and there's a lot of reason to be doubtful that things are really going to be better off under nationalisation.
You've pointed out some of the flaws in nationalisation. Why do you think, according to the polling, it's such a popular policy?
Yeah, look, I think there's undoubtedly a lot of nostalgia for the idea of having a single national rail operator. I think undoubtedly the current system isn't working as well as it could. Now, there are some good parts of the system, and Labour isn't getting rid of that in particular. So you have open access, for example, the Lumo service that competes with NLER for trains up to Edinburgh. Now, that part of the system works very well. It's very competitive. The problem with the way the system was privatised and the way the franchises operate at the moment is there's very little competition between different railway operators, and that means people don't get the service they want. We also have a few other issues here as well that are more structural, which is you have seen a reduction in passenger numbers since COVID, which means that the taxpayers ending up subsidising quite a lot. And also you've got quite militant unions that are going on strike and are quite expensive to try to address. Now, the problem of nationalisation doesn't solve that problem. If anything, it makes it worse. So the risk is that I think in a nationalised industry, you'll see even more national strikes, and the unions will be even more powerful to get more demands for their members and their higher pay. But at the cost, there might be poorer working practices, there might be less efficiency, there'll certainly be little incentive from the centrally planned system to ensure customers are served well. So I think it's quite a really risky proposal Labour's going down, and it could end up with everyone a little bit less happy in a few years' time.
Is there anything that we can learn from nationalised rail networks elsewhere? I mean, a lot of people say the German system is very good, although German rail punctuality is even worse than it is here in the UK. I mean, the one that everyone talks about as being really, really good is the Swiss railways. Is there anything we can learn from them?
Yeah, I mean, there is a bit of a temptation to idolise other countries. You know, people often say things like, well, isn't it cheaper to get railway tickets in continental Europe? I mean, the answer to that is, of course, yes and no, which is if you book in advance in the UK, usually often railway tickets are cheaper for long distance. I mean, what the EU is actually doing at the moment when it comes to rail is quite interesting, which is they are going very heavily down this open access direction. So there is actually increased competition in European long distance railway and more operators coming on board to compete with the national providers. I don't think people in Germany are that particularly happy with their railways at the moment and in other parts of Europe either. I mean, we can also look further afield. For example, Japan has fantastic railways, largely privatised, and they have lines competing with each other. So they have the tracks and the trains owned by one company rather than separating it, which is what we have in the UK. I mean, that's a completely different model of operation, but seems to work quite effectively.
Yeah, that's absolutely right. I mean, why is it, though? I mean, open access has worked really well where we've had it in the UK, but why has it been so limited? I mean, if I think of, for example, the Great Western Line, I mean, that looks tailor-made for a bit of competition.
Yeah, it's a good question. There is a bit of a tension here because if you have more competition and it pushes down passenger costs, then there's basically less the Department for Transport can extract out of the companies. So it becomes kind of less financially viable in the government's minds, or that they get less payments. So the government likes the idea of franchising because it means they get a big payment back from the companies. I think it's just been a bit of a disappointing model, though, because a franchise is just a state-given monopoly to one particular private company. Now, moving that monopoly to one national entity isn't any better than that. Labour isn't getting rid of open access altogether. I suppose what worries me, though, is if you have a nationalised system and you have a state operator, the incentive will be not to allow too much open access to compete with the nationalised operator.
All right, Matthew, you've got to leave it there. Good to talk to you this afternoon. Thank you.
Thanks for having me.
Some other business news stories for you now. What a day it's been. Lots going on today. Shares of Anglo American have surged by 16% on news that the FTSE 100 miner has received a $39 billion takeover approach from its larger rival BHP. A deal would make BHP, which is already the world's biggest mining company, the globe's biggest copper producer, accounting for around 10% of global supply. Anglo American is also a major producer of platinum group metals, iron ore and metallurgical coal, as well as owning an 85% stake in De Beers, the world's biggest diamond producer. Barclays has suffered a drop in quarterly profits on the back of a weaker performance in its trading arm. The lender achieved a pre-tax profit of £2.3 billion for the first 3 months of the year. That was down 12% on the same period last year. Barclays said trading revenues from fixed income commodities and currencies fell during the period, as did the fees its investment banking division makes from advising clients. The news comes a day after Lloyds Banking Group reported a drop in quarterly profits. The consumer goods giant Unilever said today it was confident of growing sales volumes this year as inflation continues to ease. The company, which said sales volumes had already begun to recover in markets such as the UK and France, was reporting a 4.4% rise in underlying sales growth to €15 billion for the first 3 months of the year. It highlighted particularly strong performances from Dove, Knorr, Axe and Sunsilk. Shares of Unilever have risen by 5%. Now, the last 12 months have been very tough for independent TV producers as broadcasters have sought to save money by pausing, cancelling or phasing the commission of shows. But one company apparently bucking that trend is Zinc Media, the company behind the BBC's Putin versus the West documentary and Channel 4's Gender Wars. Well, Zinc, which has just won its biggest ever commission for a US TV series in Top Gun: The Next Generation, today reported a 34% rise in full-year sales to £40 million, while underlying earnings rose from £100,000 to £1 million. I've been speaking with the chief executive, Mark Browning, and began by asking him why he thought he'd buck the trend.
We've made a lot of investments in the previous years, and we've diversified into lots of new markets. So in that sense, we've spread our bets wide. And good ideas still sell in bad times. So I would say they're probably the main 3 reasons.
You've had a few productions nominated for awards. If you had to highlight one in particular that you were particularly pleased with this year, what would it be?
The real Top Gun is a big moment for us because it's a US commission. It's for a Disney-owned channel, and everybody can relate to the movie. So telling the story behind those things and bringing those characters to life and showing what it's really like to be a US Navy trainee pilot has got to be one of our top shows that's in production at the moment.
What have you seen in terms of costs over the last 12 months?
Well, there have been a lot of cost increases. Travel, the boring stuff, accommodation, you've got crews around the world. But you can still find margin if you've got infrastructure, and Zinc has a platform. It has all of this in-house. It has expertise, which means you can do things at high volume and bring costs down, and you can do things at massive cost, like big SVOD commissions, and make a profit off them.
Now, 80% of your work comes from existing customers. Do you see that coming down over time?
No, I think that's going to be our ambition. It will ebb and flow a little bit, but across brands and businesses and TV, they're not always buying the same thing. Increasingly, they're returning for another series, but they're coming back going, I want to come back to the shop. And so and 80% retention is about revenue quality for us.
One hears an awful lot about bureaucracy in the world of TV. Is it taking longer for commissions to actually land?
Some channels take a long time, and actually time kills good ideas. So one of the things I think our sector needs to do is, and they do this in the US very well, they say no well. That's a much better outcome than we're thinking about it. Other channels are super fast and as a result get a competitive advantage. So yeah, I think it's something that creative types can choose to boil the ocean on decision. Sometimes you just need to say no or yes, preferably yes.
Yeah. Now you also make corporate films as well as productions for the likes of BBC, ITV and Sky. What are you seeing on the corporate film side?
Well, there's lots of different sectors. Increasingly, brands want to tell their story using film. Everything is on screen. Whether we like it or not, everything is on screen. So we all have to tell our stories, whether you're in retail, whether you're in fashion, whether you're in mining, you need to tell your story on film. And we are filmmakers, we're storytellers. It might be, as you say, for a documentary for Sky or the BBC or someone else, but it might be for a brand. It's the same skill set. And actually, in terms of what powers it, it's the same production company that can power it. That's where you get the margins from.
Are the stories that you're being asked to tell on behalf of corporates changing particularly?
I don't think they're changing particularly. They've always been, they're changing how they want to tell it. I think bringing it to life, you know, sometimes business can be quite hard to translate. And I think the use of film can mean the product comes to life, the people come to life. People want to know who's behind the company, not just what they do or what market they're in. Who am I talking about? Who am I buying? What am I making? What's my product? Film brings that to life. So it's those sort of stories.
Now, you've been pretty acquisitive in the past, and you've made no secret of the fact that you're looking for more. Is there anything imminent on the horizon?
We made an acquisition 18 months ago, and it's worked very well for everyone involved. And to scale our company, we're going to need to find suitable strategic opportunities. That might be in adjacencies. We're in a non-scripted television market. Maybe we move into drama or entertainment or other areas. Maybe we move more into brands. So we are on the lookout for where we might be able to bring adjacencies and scale to the group, because that's ultimately where we will get more resilient financial performance.
And can you do everything that you want to in the public markets? If you get an acquisition opportunity of sufficient scale, are you confident that you'll be able to raise the money you need?
Yeah, I think confidence is returning. You know, it was difficult last year, everybody knows that, but everything I'm hearing now is bring us a good idea, bring us a good investment, make sure it's a great company, and people are finding more confidence. And I think as we go through 2024 into 2025, that's only going to get better. It has to. It's been pretty bad for a long time. All signs are this is improving.
And I can tell you shares of Zinc Media have finished the day 2.5% higher. By the way, if you've been watching closely at the bottom of the screen, you'll have seen the closing price for the FTSE 100. That is another all-time closing high for the FTSE, the third one this week. We'll have more on that later in the programme. But some other business news for you now. And Sainsburys claimed today it is winning market share from low-cost rivals Aldi and Lidl, as well as from upmarket competitors such as Waitrose. The UK's second biggest supermarket, which also owns Argos and Habitat, was reporting an underlying pre-tax profit of £701 million for the year to the 2nd of March. That was up 1.6% on the previous 12 months. Sainsburys, which highlighted particularly strong sales of its Taste the Difference range, said it expected to continue momentum into the new financial year with a more normal summer expected than last year's cool and wet weather. Well, we can all hope, can't we? Continued strong sales of its blockbuster cancer medicines have helped AstraZeneca, the drug maker, to better than expected quarterly sales and earnings. The UK's biggest company said sales in the first 3 months of the year came in at $12.7 billion, which was up 17% on the same period last year. Within that, its oncology treatments saw sales grow by 23%, while its cardiovascular, renal and metabolism treatments grew sales by 20% during the period, led by its diabetes and heart failure treatment Farxiga. Shares of AstraZeneca are up by 5%. And WH Smith said today it expects to open 110 stores this year, around half of which are expected to be in North America. The company, which has pivoted from the UK high street to being a global travel retailer, said it expects to open between 50 and 60 stores each year in coming years in airports, railway stations and hospitals around the world. In the last 6 months, it opened what it called significant new stores at Salt Lake City, Nashville, Boston, LaGuardia, Denver, Chicago O'Hare, Washington Ronald Reagan, Las Vegas and Los Angeles airports. Half-year pre-tax profits, so, fell from £45 million to £28 million. That was due mainly to higher finance costs and to some accounting changes. Well, still to come here on Business Live. As I've just said, it's another record-breaking day for the FTSE. We'll have a look at the markets next. Stay with us.
I'm Greg Milam and I'm Sky's Chief North of England correspondent. I've reported from around the world and around the UK.
I'm Mark Stone, I'm Sky's US correspondent based here in Washington, DC. And beyond the United States, from across the world, I report on the biggest stories.
I'm Stuart Ramsey and I'm Sky's Chief Correspondent.
I'm David Blevins and I'm Sky's Senior Ireland Correspondent. I remember some of the worst of the violence here.
I'm Alex Crawford and I'm Sky's Special Correspondent based in Istanbul.
We've got your Sunday mornings covered. From the front page and the sounds of the streets to the voices of the people who make the major calls and big picture politics beyond Westminster. We'll put you at the heart of our story. A new start to Sunday.
I'm ready. Are you?
Join me, Trevor Phillips, Sunday mornings on Sky News.
If you forgot your pajamas, Emirates has got you covered. Fly Emirates, fly better.
Welcome back. Let me tell you what's been going on the markets. And while the FTSE has hit another closing high, it's been a brutal session for stocks everywhere else this afternoon. Following news that US GDP grew at its slowest pace in nearly 2 years. During the first 3 months of the year, GDP grew by 1.6% on an annualised basis against Wall Street expectations of 2.4%. At the same time, one of the main measures of inflation, followed by the US Federal Reserve, came in ahead of expectations. Well, here's how they finished in continental Europe. All of the main indices in negative territory on a very busy day for company earnings. Nestlé has fallen 3% in Zurich after its quarterly sales growth missed forecasts, while the Dutch payments giant Adyen has slumped by 18.5% for similar reasons. Well, here we go. Let's bring you some brighter news. Here's the FTSE right now, up just under 0.5% right now. It hit a fresh intraday high and a fresh closing high. And that is thanks mainly to a clutch of very strong results, not least from AstraZeneca at the top of the screen there. As you can see, AstraZeneca up nearly 6%. Due to its size, that has added more than 36 points to the FTSE on its own. Anglo-American has chipped in another 16 points on its takeover approach. Meanwhile, Unilever, another big heavyweight earner, that's added another 19 points to the FTSE. The FTSE would have been in negative territory without those three. To the downside, a clutch of insurers and asset managers led by Legal & General, which is off 6% on the session, Schroders, which is off 5.5%, and St James's Place. Outside the FTSE, the motor dealer Inchcape has finished up nearly 9.5% better after its quarterly results beat expectations, while the long-suffering Hypnosis Songs is up another 2% following the latest shots in the bidding war for that company. Over on Wall Street, while stocks have opened very much to the downside on that economic data, one of the highlights, or lowlights if you prefer, is Meta. That's fallen by some 9% on a disappointing results statement overnight. Meanwhile, the industrial bellwether Caterpillar, that's currently off 6.75%, also on a downbeat trading update. On the foreign exchange markets, well, here's the current picture. Sterling 0.25% higher against the dollar, more or less unchanged against the euro. The single currency up 1/6% also against the greenback. Meanwhile, the oil price, well, that has been falling this afternoon, currently on course for its 7th fall in 9 sessions. Barrel of Brent crude will currently set you back $87.73 a barrel. That's off 1/3 of 1%. Well, as I say, it's a very busy news day today. No one better on these occasions than Robert Ulster, the Chief Investment Officer at Close Brothers Asset Management, to talk us through it. Robert, good to see you. We've got to start with Anglo-American. What do you make of this?
Yeah, so Anglo-American receiving unsolicited bid by BHP, the dual-listed Australian UK miner, 4 times the size of Anglo. So what's going on here? Well, to some extent, it's opportunistic. Anglo-American share price has been falling. They've had some operational issues, the management reviewing the portfolio, so good timing by BHP. But the essence here is about copper. BHP want to increase their copper proportion. Anglo-American has some great mines just starting up. Why copper? It's in electric vehicles, it's in the grid, it's in data centres. It's basically the metal of the future. So that's what's going on here. And BHP paying a roughly 20-30% premium because it's all dependent on some spin-offs. And we'll have to see between now and, the 22nd of May, when they have to make a final offer. And, of course, the real excitement is, does somebody else come in to make a counter-offer?
Absolutely. I mean, the other question I'd have is, surely competition regulators are going to be all over this one?
They are, and of course it's going to be in local jurisdictions. So you've got South Africa, you've got Australia, you've got the UK and South America as well. So you're right, it's a sort of bean feast in a way for the regulators, and they'll have to possibly change the deal depending on what the regulators say.
Yeah, it's going to be keeping this in business for a while, this one, isn't it?
Very much so, yeah.
What about AstraZeneca? I mean, another blockbuster set of numbers.
Yeah, you're right, and up 7% on the first quarter sales numbers. Compared to the consensus, driven by the oncology drugs like Tagissa, and also the legacy drug, Symbicort, for asthma sufferers, also going very, very strongly. Good cost control, so earnings up 7%, reiterated guidance, just good numbers.
Yeah, very reassuring. Barclays. Now, the share price rose. On the face of it, I didn't think it was a great set of numbers.
Well, yeah, I guess it rose because the revenues and the profits, to some extent, were ahead of consensus, despite, as you said in the intro, slightly down. But because they beat consensus, that's the reason why. And also, there were some sort of prospects for UK growth in terms of looking at some of the loan growth there as well. In the US, the consumer secured and unsecured are going quite well. It was just the investment bank, really, that fell behind, for example, some of the peers. So mixed, but on the whole, quite favourable results compared to what the market was expecting.
Yeah, I mean, we've heard from some of the big Wall Street players, most notably Goldman Sachs. They had a pretty good quarter in investment banking. It doesn't seem to have happened for Barclays.
No, and that, of course, is going to be, there's a management plan to relook at and improve the efficiency and performance of that. So I think the market's expecting that to come through and to hear more from Barclays on that area.
Yeah. Now, another big one that's reported today was Unilever. Again, surprised on the upside.
Yeah, so about 4% on sales versus the consensus. As you said at the beginning, some of the power brands, their major brands, Knorr, Dove, driving the sales improvement, plus Latin America. In fact, if you go through all the sort of subdivisions, beauty, home care, personal care, they're all doing very, very well. So, again, a good set of results driving the UK market higher.
Yeah, Napoleon said, give me a lucky general. I mean, since Heinz Schumacher became CEO here, they've had nothing but good news. Has he just been lucky?
No, I think there's a revision of the whole portfolio and understanding about the power brands and their importance, a realignment of how the management operates. So, yeah, OK, it's luck, but there's also a plan.
Now, over in the States, of course, disappointing results from Meta overnight.
Yeah, that was very interesting, actually, very interesting, because the first quarter revenues and profits came in slightly light, but not enough to cause a sort of 15% after-market fall in the share price. It's what he said about AI and the increase of about 10 to 15% in capital expenditure in AI. And everyone went, hang on a second, we've been here before, the metaverse, virtual reality. And everyone's thinking, just how big a black hole is AI going to be? On the other hand, those numbers did show some benefits from investing in artificial intelligence. So it's really all to play for with Meta and how they do in AI going forward.
OK, Robert, we have to leave it there. Great to have you with us this afternoon. Thank you. Just before I go, let me show you the latest pictures from outside the Post Office inquiry. Angela van der Bogert has just left. Here she is. We will have more for you on that in the News Hour, which is coming up with Mark Austin after this short break. I'm back tomorrow. Hope very much to see you there. Thanks for joining me this afternoon. Cheerio.